Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Being a value investor at its core really is about taking advantage of the opportunities that investing in equities or common stocks can give you, but doing it at a very controlled level of risk. That's really what value investing is all about. And approximately 3 years ago, just shy of that, I did a video where I talked about Nike and Disney, two of the most, especially at that time, two of the most popular stocks on the planet. And by the way, they had become excessively overvalued based on any rational estimate of intrinsic value of what a company is worth using things like discounted cash flow analysis, etc. And in that video, I was primarily talking about valuation risk. And again, value investing is all about controlling risk. Well, 3 years later, I'm going to show the results of what that video showed. I was pointing out that both of those stocks, although they were great businesses, were overvalued. However, a couple of things happened, and I'll be covering that here in the video. So what I want you to do is I've took a snippet of that video because I talked about the risk of high valuation, and I did it as well as I probably could. So rather than try to redo that, I've just copied what I spoke about in that video as an intro to the video I'm doing now. So let's take a look at the video I did on October 14th, 3 years ago approximately, 2021. And then let's go ahead and look at what the outcome of the two stocks I covered, Nike and Disney, look like today. What I want to do in today's video, I want to talk about risk, because at its core, at its heart and soul, if you will, valuation and being a value investor is all about risk and all about risk control. All right. And, it really comes down to how much risk are you willing to take to earn a rate of return, and how much risk might you take, which could actually destroy your rates of return, and a lot of times inadvertently. Ben Graham, the teacher of Warren Buffett, once famously said that in the long run, the market is a weighing machine. And what he means by that, I want you to think about that. It's a weighing machine. In the long run, it's the weight of the business that matters. And that weight of the business is measured by fundamentals, earnings, cash flows, balance sheets, the strength of its financial statement, et cetera. But in the short run, it's a voting machine. And people vote their dollars, and that drives stock prices up and down. And that's why stock prices are so volatile. My own version of that is that earnings determine market price in the long run. That's critically important because value is all about discounting future cash flows back to the present value. That's one of the core features of being a value investor. So value is about how much money can you make on the investment. And of course, that's going to be directly related, if you just stop and think about it and apply common sense, to how much money the entity that you invest in this case, we're going to be talking about common stocks, is capable of generating for you as an investor. And then how will that money reward you? At what rate will that money reward you? Because there's a big distinction here that I want to make. And I'm going to talk about the difference between a very high quality business, which is what value investors are really looking for. And the reason for that is because we want to be long-term owners of great businesses, quote unquote, bought at attractive valuations. That's the key part of this whole process, because a great business can simultaneously be a very risky and therefore in the long run, a very lousy investment. Okay, because valuation matters, and valuation matters a lot. So what I really want to talk about today is risk and risk control, and why it's so important to you as an investor. I want you to go back and think about, in the long run, the market's a weighing machine. In the short run, it's a voting machine. Or earnings determine market price in the long run, and emotions determine market price in the short run. And the key is earnings are real. It's money. It's tangible. It's fundamental. Emotions are ethereal. They can come and go with the wind. If the wind changes directions, emotions can go from, euphoric to panic, and they can do it in an instant. And we've seen untold cases of that in, stock market history. So I'm going to feature two companies today and primarily talk about them as risk. And I'm going to utilize the FastGraphs Fundamentals Analyzer tool to do that. But I want to say something about FastGraphs. And people make the mistake. FastGraphs is not a market timing tool. It's primarily at its best a risk assessment tool. It basically shows you, relative to the fundamental values of a business, how much risk you would be taking to invest in it, or conversely, how much opportunity you might have if you're looking at the opportunity to buy a great business at a very low valuation or at an attractive valuation. So it's really about risk control. And risk control isn't about timing the market, and it isn't about having perfect timing. The principle that emotions drive the market in the short run is very real. That's a fact. You've seen panics where people sell stocks that shouldn't be sold. And you've also seen euphoric times when the market values, and I think we're in one of those today, where market values get ridiculous high beyond anything that measures common sense or good business judgment or good business sense. And we get these crazy valuations. So what I want to do is I want to try to put that into real good perspective by looking at two of my favorite companies on the planet. But woe is me, they're two companies that I cannot invest in today. And that's, as a value investor, that's very, very frustrating, because these are exactly the kind of businesses that I want to own for the long term. All right, this is Chuck Carnevale again. I hope you enjoyed that, and I hope you took heed of that. High valuations are very, very risky, as I'll point out here in a moment. To do that, let's go ahead and go into the Fast Graph Fundamentals Analyzer research tool, and let's look at what happened to those stocks from that October 14th, 2021 date till today. The first one I want to look at is Nike. Now, if you watch that video, I put a link to that video with this video. If you watch that old video that I did on October 14th, 2021, I've got a red dot here on October 15th, a day later. I want you to note that two things happened. The first is I was pointing out how massively overvalued, how Nike stock had gotten very, very highly valued. And by the way, it did this for years. All right, but then two things happened. One is, because of the high valuation, we had a catalyst come where the operating results didn't do as good as everybody was hoping. And I'm going to show you that here in a moment with the analyst scorecard. But the other is the stock collapsed in value. So if you'd have bought the stock on that day, or if you held it on that day, today you'd be down over 43% on the stock. Roughly, not quite, but you almost had your money cut in half. In fact, at its bottom, you probably would have had your money more than cut in half, but it started to recover a little bit. But I want you to notice the earnings line on this stock now. If you look at go and watch that old video, the earnings were expected to be a lot higher than they actually came out. So let's go ahead and go into Nike and go into the analyst scorecard, and let's look at what happened in 2021. Actually ended up, and that was a May fiscal year, by the way, ended up being a better year than the analysts had expected. But then 2022 earnings were down more than 4%, almost 5% lower than what analysts anticipated. But then 2023 earnings were down 28%. And then 2024 was even worse. Now, if you go 2-year forecasts, you'll see that earnings were down 31% in 2023 and 27% using round numbers in 2024. So the point is that the earnings did not come out anywhere near what analysts had expected. So the two things happened. One is the stock price was way overvalued, and just a little catalyst came in where earnings got a little iffy. And the stock, of course, with a lot of volatility, you could see how people continue to want to support this stock by seeing these real peaks and valleys here that Nike stock suffered during that time. Okay. But today, when I'm looking at Nike, and I want to do that with you, Nike's expected to have a down year this year, and they're struggling. There's been recent articles in the Wall Street Journal. They're struggling finding their mojo again. But analysts, once again, do expect after this year to start seeing double-digit earnings. Remember, this is the May fiscal year, so we're going through May of 2025 here. By May of 2026, we expect to see some recovery, but I would still argue we still have valuation risk and we still have execution risk, because obviously Nike hasn't been able to basically generate the returns that analysts were expecting. Okay, so bottom line is high valuation as a value investor was extremely high risk. Now note that Nike stock price did rise for a couple of months. In fact, up through really October of 2021. Let me go find the date here. through December of 2021 and actually into January of 2012, Nike stock did rise from when I first did the video, but then it started this tremendous drop. Then it rallied again, then it dropped again, rallied again, dropped again, it's rallying again. But I do think the stock is still currently overvalued. Now, it's an extremely high-quality company, AA rated, only has 41% roughly debt to capital, does offer a decent dividend yield. Their dividend record was actually been pretty good through this period of time. They continued to maintain their dividend. But if I look at things like operating cash flow on Nike from this period of time, it did cover the dividend. So the dividend has stayed relatively safe. Now, free cash flow to equity, which is even more important, we did get it to where it didn't cover the dividend in 2020, but it's been covering it ever since. So the dividend record still stayed strong. But the key is not to have bought Nike when it was trading at a crazy valuation like it was in October of 2021. Or the other thing you could say is that if you bought it back here when it was reasonably valued, you might have either sold it or taken some money off the table. In other words, just do it, sell would have been my mantra at this point in time. Now let's go ahead and look at the second stock in the group, and that would be Walt Disney. Okay, now Walt Disney went through a bunch of stuff. Of course, COVID really impacted Walt Disney more than a lot of companies because they had to close their theme parks and everything, so earnings disappeared. But yet people continued to have faith in Disney even though the earnings had collapsed. Then they eliminated their dividend. And of course, once all this really began to add up, the stock price, just like we saw with Nike, and I'm going to go to the bottom here, it collapsed about approximately 50% as well, over 49%. All right, so that was a period of very high valuation. But also, we're going to see when we go into the earnings forecast and go into the earnings scorecard on Disney, they've put together 5 or 6 years of missing earnings estimates by extraordinary margins. Okay, and that had to weigh on the stock. Now, analysts do expect this stock to recover. This would be a historically normal PE ratio for Nike. And by the way, this is the 19-year historical normal. Again, when I look at this stock historically, you can see that there were a lot of times where the market put a 20 multiple, but there were also, to be fair, a lot of times where the PE multiple of Disney was also a lot lower. It is currently trading around a blended PE of around 19, which would technically be below its historical norm, which I've shown you here on this particular graph. But if you look at, say, a 15 PE, which would be more normal, we would still get a positive rate of return, but it's not real attractive at these levels. So there's still a lot of risk in Disney, but Disney, perhaps, of the two, would be a little better short-term buy based on Nike. Now, these estimates may turn out to be inaccurate because Nike's working on doing a lot of things to try to get their mojo back. And there have been several articles in things like the Wall Street Journal, et cetera, that have talked about Nike trying to resurrect its slagging sales or slowing down sales and so on. And that's something for you to think about when you're looking at these stocks. The question is, don't go by the historical reputation. Look at what the market expects for the company going forward. And actually looking at sales would be interesting to do with Nike. I do want you to note that sales have flattened significantly. And of course, when you look at price to sales, Nike would be trading at more of a normal price to sales today, but we're not looking at a lot of sales growth. So from a forecasting point of view, a 2.5% sales growth would still give you less than a 5% rate of return if you invested in Nike and it traded at its normal price to sales. Okay, so both of these stocks still continue to have their issues. Anyway, this is Chuck Carnevale once again, and I want to point out that you can see how valuation worked out. It's been 3 years almost since I covered these stocks originally, and we saw these tremendous drops in their stock prices. We also saw some great challenges in their operating results. And I want to make that point. When you're an investor in stocks, you can use things like fast graphs and the forecasting tools and the analysts' estimates and the scorecards, but you got to monitor that stuff because things can change and they can change abruptly. And the point is, if things do change, then you got to be positioned to change your mind. So if you're going to be a successful investor, You've got to focus on trying to buy stocks when they're attractively valued based on the best information you can gather. But then you also have to make sure that you keep up with that information and make sure things don't change a lot. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. If you like this video, give me a like, ring the bell. Take a look at the old video I did 3 years ago. I think you'll find it interesting when you look at what I was showing on the stocks. And if you don't already subscribe to our YouTube channel, please do. And if you don't subscribe to FastGraphs, for goodness sakes, take advantage of the benefits that this tool, this risk mitigation tool, offers you, and at least try a free trial today. Thanks for watching. We'll talk to you again real soon.